August 22nd, 2023. Johannesburg, South Africa. The BRICS summit announces 6 new members joining the bloc: Saudi Arabia, the UAE, Iran, Egypt, Ethiopia. Argentina initially said yes, then backed out, but the others are in. You probably saw the headlines, maybe scrolled past. Another international alliance, whatever. But here's what didn't make the headlines. 3 weeks after that summit, Saudi Arabia did something they haven't done in 48 years. They sold oil to China, paid in yuan, not dollars, yuan. Then in September, the UAE did the same thing. Oil sale to China, yuan settlement. Then India and Russia started trading in rupees and rubles, completely bypassing the dollar. Then Brazil and China set up a direct currency swap. No dollars involved. These aren't proposals. These aren't negotiations. These are actual transactions happening right now. Billions of dollars worth of trade, settling in currencies that aren't dollars. And if you're thinking, so what, that doesn't affect me, let me show you why you're wrong. Because every time a barrel of oil gets sold without dollars, every time a trade happens without touching the dollar system, something happens to your money, your actual purchasing power, the value of every dollar in your bank account, and it's accelerating. Let me walk you through exactly what's happening and why it matters more than almost anything else in the global economy right now. So first, you need to understand what the dollar actually is on the global stage, because it's not just money, it's infrastructure. After World War II, the world basically agreed that international trade would run on dollars. If Japan wants to buy oil from Saudi Arabia, they do it in dollars. If Germany wants to buy electronics from China, they do it in dollars, even if America isn't involved in the transaction. Why? Because in 1944 at Bretton Woods, the Allies set up a system where the dollar was backed by gold and every other currency was pegged to the dollar. Then, in 1971, Nixon ended the gold backing, but by then, it didn't matter. The infrastructure was already built. The banks, the payment systems, the contracts, everything ran on dollars. And here's the key part. Because everyone needs dollars for trade, everyone has to hold dollars. That creates automatic demand for U.S. currency and U.S. Treasury bonds. It's what lets America borrow $36 trillion and still have people lining up to lend more. It's what keeps interest rates lower than they should be based on our debt. It's what allows the Federal Reserve to print trillions during a crisis without the currency collapsing. The technical term is exorbitant privilege. It's a superpower that no other country has. But that system only works if everyone keeps using it. Now let me show you what's changing. BRICS started as just 4 countries in 2009. Brazil, Russia, India, China. South Africa joined in 2010. For years, it was mostly talk, meetings, declarations, grand statements about multipolarity and challenging Western dominance. Nothing concrete. Then 2022 happened. Russia invades Ukraine. The West responds with the most aggressive sanctions in modern history. They don't just sanction Russian companies. They freeze Russia's central bank reserves. $300 billion, just locked, gone. Russia held those reserves in dollars and euros, kept in Western banks, thinking they were safe. Untouchable. That's what reserves are supposed to be. Your insurance policy, your emergency fund, and the West just took it. Now put yourself in the shoes of every other country watching this. China holds over $3 trillion in foreign reserves. A big chunk of that is in dollars. Saudi Arabia holds $600 billion, UAE $170 billion, India $600 billion. They all just watch the West demonstrate that if you piss off Washington or Brussels, your reserves can vanish. Doesn't matter if it's your money, doesn't matter if it's legal under your system, if it's in dollars and sitting in Western financial infrastructure, it can be weaponized. That was the turning point. That's when BRICS stopped being a talk shop and started building actual alternatives. By 2023, they're not just talking anymore. They're doing. The New Development Bank, BRICS alternative to the World Bank, starts issuing loans in local currencies, not dollars. Yuan, rupees, rand, whatever. They're building payment systems that bypass SWIFT, the Western-controlled messaging system that moves money internationally. China and Russia built a CIPS, the cross-border interbank payment system. It's not as big as SWIFT yet, but it works. Money moves, trade happens, no dollars needed. Then the big one. At that August 2023 summit, there was talk about a BRICS currency, a new reserve currency backed by a basket of commodities or gold or member currencies. The details are vague and it probably won't happen soon, but the fact that they're discussing it openly tells you where this is going. And now with those 6 new members, BRICS represents roughly 45% of the world's population, and depending on how you measure it, around 35% of global GDP. That's bigger than the G7. More importantly, they control resources. Saudi Arabia and UAE are 2 of the world's largest oil exporters. Russia's got natural gas and wheat. Brazil's got agriculture. Iran's got oil. China's got manufacturing. India's got services and a massive consumer market. Between them, They produce or control a huge chunk of the commodities that the world runs on: oil, gas, metals, food, and they're starting to trade those commodities in their own currencies. Here's where it connects to you. Every time a trade happens in yuan instead of dollars, that's demand for dollars that didn't happen. Every time Saudi Arabia sells oil for yuan, that's one less reason for China to hold dollars. Every time India and Russia trade in rupees and rubles, that's dollars sitting unused. And when demand for something falls, what happens to its price? It goes down. If demand for dollars falls, the value of the dollar falls. And when the dollar's value falls, everything you buy that's imported or made with imported materials gets more expensive. That's your gas, your electronics, your clothes, a lot of your food. But there's a second effect that's even bigger. Right now, because the world needs dollars, they buy US Treasury bonds. That demand keeps interest rates lower than they'd otherwise be. The US government pays less to borrow. That keeps mortgage rates lower, corporate borrowing cheaper, the whole economy benefits. If that demand drops, Treasury yields have to rise to attract buyers. That means higher interest rates, higher mortgage payments, more expensive car loans, credit card rates go up, business investment slows, the whole thing tightens. And there's a third layer. The US has been able to run massive trade deficits for decades because the world needs dollars and is willing to take them. We buy more than we sell, ship dollars overseas, and those dollars come back as investments in Treasury bonds or US assets. If that recycling mechanism breaks down, we can't run those deficits anymore without consequences. Either the currency adjusts sharply, or we have to actually balance trade, which means consuming less. All of this sounds abstract until you realize it's already starting to happen. It's not a future scenario, it's now. Let me show you the actual numbers because this isn't theory anymore. In 2001, the dollar made up about 73% of global foreign exchange reserves. That's the money central banks hold as their safety net. By 2024, that number dropped to roughly 58%. 15% doesn't sound like much, but we're talking about a market measured in trillions. A 15% shift represents roughly $2 trillion of reduced demand. That's not a rounding error, that's a structural change. And the pace is picking up. Most of that decline happened in the last 5 years. Look at oil, because oil is the foundation of the whole dollar system. For almost 50 years, oil has been priced and sold in dollars. It's called the petrodollar system, and it started with a deal Henry Kissinger made with Saudi Arabia in 1974. The deal was simple. Saudi Arabia agrees to price oil in dollars and invest their oil revenues in US Treasury bonds. In exchange, America provides military protection and weapons. Every other oil producer followed Saudi Arabia's lead because if you wanted to sell to the biggest customers, you needed to match the price in dollars. That created a permanent flow. Countries need oil. To buy oil, they need dollars. To get dollars, they sell us stuff or buy our bonds. The dollars flow out through our trade deficit and come back through Treasury purchases. It's a closed loop that's been running since the 1970s. June 9th, 2024, that 50-year agreement between the US and Saudi Arabia quietly expires. No renewal, no announcement, no headlines, it just ended. Now Saudi Arabia can sell oil in yuan, euros, rupees, whatever currency the buyer wants, and they're doing it. Not exclusively, most oil is still priced in dollars, but the cracks are forming. China is Saudi Arabia's largest customer now, bigger than the United States. China buys about 1.8 million barrels per day from the Saudis, and increasingly, those sales are settling in yuan. Here's why that matters. China used to need to hold massive dollar reserves to buy oil. Now they can use yuan. That's less demand for dollars. And the Saudis, instead of taking those dollars and buying US treasuries like they used to, they're holding yuan, or converting it to gold, or investing in Chinese infrastructure projects. The loop is breaking. And it's not just oil. Look at what happened with Russia after the sanctions. Before 2022, Russia did most of its trade in dollars and euros. After the sanctions cut them off from SWIFT and froze their reserves, they had no choice. They switched. Now Russia and China trade in rubles and yuan. Russia and India trade in rubles and rupees. Russia sells oil to India. India pays in rupees. Russia uses those rupees to buy Indian goods. In 2021, the dollar and euro made up about 85% of Russia's trade settlements. By 2024, that number fell below 20%. The yuan alone now accounts for over 40% of Russian trade. One country, sure, but Russia's the 11th largest economy in the world and a massive commodity exporter. When they leave the dollar system, that's real volume disappearing. Then there's China's move. China holds about $775 billion in US Treasury bonds as of late 2024. That's down from over $1.3 trillion in 2013. They've been selling. Slowly, steadily, not all at once. That would crash the market and hurt them too. But the direction is clear. They're also signing bilateral currency swap agreements with dozens of countries. These agreements let two countries trade directly in their own currencies, without touching dollars. China has swap lines with Russia, Brazil, Argentina, UAE, Saudi Arabia, Pakistan, Turkey. The list keeps growing. Every swap line is a pipe that bypasses the dollar system. Now let me give you the historical pattern, because this has happened before. In 1944, the British pound was still technically the world's reserve currency. Britain had the largest empire, the most developed financial markets, centuries of being the global economic center. But World War II destroyed their economy. They were broke, deeply in debt, and the US had become the real economic superpower. So at Bretton Woods, the world quietly shifted. The dollar became the new reserve currency. Not because Britain agreed to give it up, but because the economic reality made it inevitable. The pound didn't disappear overnight. For decades, it was still used in lots of trade, especially within the Commonwealth, but the dominance was gone. And once that dominance breaks, it accelerates. Countries start diversifying away. Less demand means weaker currency. Weaker currency means more reason to diversify. It feeds on itself. The transition took about 30 years to fully play out. During that time, Britain went through currency crises, inflation spikes, having to go to the IMF for bailouts. It wasn't pretty. Now look at the US position today. We're running a $36 trillion debt. We run a $1 trillion budget deficit every year. Our manufacturing base has been hollowed out over decades. We import way more than we export. The only reason we can sustain this is dollar dominance. Because the world needs dollars, they lend to us at rates lower than our debt would otherwise command. We get to borrow cheaply and spend beyond our means. But BRICS is building the infrastructure to change that. Not next week, not next month. But the foundation is being laid right now. And here's the part that should worry you. Once reserve currency status starts to slip, there's no examples in history of it being reversed. The British pound never regained its position, the Spanish real, the Dutch guilder, all the previous reserve currencies, once they lost dominance, it was gone for good. The difference this time is speed. Britain's decline took decades partly because there was no alternative system ready to go. The infrastructure had to be built from scratch. BRICS isn't starting from scratch. They've got China's manufacturing base, the world's second largest economy. They've got Russia's commodity exports. They've got India's growing market. They've got the Gulf states' oil and capital. They've got payment systems already functioning. They've got bilateral trade agreements already in place. They're not trying to blow up the dollar system tomorrow. They're building an alternative that makes it optional. And once it's truly optional, once countries can conduct trade, hold reserves, and settle transactions without ever touching dollars, the demand picture changes permanently. Right now you're seeing the early stages. The bilateral deals, the currency swaps, the payment systems. It looks small, but that's how these transitions always start. Small cracks that widen into structural breaks. Let me show you what happens next. There's a sequence that plays out when reserve currencies lose their status. It's not random, it follows a pattern. Stage 1, alternatives emerge, new payment systems, new trade agreements, new currencies being used at the margins. That's where we are now. The dollar is still dominant, but the alternatives are functional. Stage 2, a shock. Something happens that makes the risk of dollar dependence suddenly very real to a lot of countries at once. For Russia, that shock was 2022 and the frozen reserves, but that only affected Russia. The bigger shock would be something that makes everyone nervous. Could be a US debt crisis. Could be aggressive use of sanctions against a major economy like China. Could be a Fed policy mistake that causes a dollar spike and blows up emerging market debts. The specific trigger is less important than the effect. Suddenly, holding all your reserves in dollars feels dangerous. Stage 3, the flight. Not panic selling, but strategic diversification. Central banks quietly shift percentages, 5% into yuan, 3% into gold, 2% into euros. Happens slowly over quarters and years, but it's steady, irreversible. Stage 4, the market adjusts. Treasury yields have to rise to attract buyers. The dollar weakens. Import prices spike. The Fed faces an impossible choice between fighting inflation with higher rates or supporting the economy with lower rates. Either choice has brutal consequences. Stage 5, the new equilibrium. The dollar is still used, but it's one option among several. Not the default, just another currency. And America has to live within its means for the first time in 50 years. We're in stage 1, moving toward stage 2. How fast we move depends on decisions being made right now in Washington, Beijing, Riyadh, and Brussels. Let me show you the mechanics of how this actually hurts you, because it's not abstract. Right now, the US imports about $3 trillion worth of goods per year. Everything from phones to furniture to car parts to food. When the dollar is strong and in high demand, those imports are relatively cheap. Your iPhone costs $1,000 instead of $1,500. Your gas is $3.50 a gallon instead of $5.50. But if dollar demand falls and the currency weakens by even 20%, that's a 20% price increase on everything imported. Overnight, that iPhone is Paulo $200. Gas is $4.20. Your grocery bill, which is loaded with imported goods and goods made with imported materials, jumps. That's not inflation in the normal sense. That's currency devaluation. And the Fed can't fix it by raising interest rates because the problem isn't too much money chasing too few goods. The problem is the dollar itself is worth less on the global market. Now layer in the interest rate effect. The US government currently pays about $1 trillion a year in interest on the national debt. That's with rates that are historically low by the standards of our debt load. If Treasury yields have to rise just 2 percentage points to attract buyers in a world that doesn't automatically need dollars, that interest expense goes up by hundreds of billions annually. That money has to come from somewhere. Either taxes go up, or spending gets cut, or they print more money, which makes the currency problem worse. And here's the real kicker. Mortgage rates in the US are tied to Treasury yields. If the government has to pay 6% on 10-year bonds instead of 4%, your mortgage rate isn't 6.5%. It's 8.5%, maybe higher. That $300,000 house you're trying to buy? At 6.5%, your monthly payment is about $1,900. At 8.5%, it's $2,200. That's an extra $400 a month, $4,800 a year. Over a 30-year mortgage, that's an extra $144,000 in interest. And that's just mortgages. Car loans go up. Credit card rates go up. Business borrowing costs go up. The whole economy tightens. This is what loss of reserve currency status actually means in your daily life. It's not some geopolitical abstraction. It's your purchasing power and your borrowing costs. Now, here's what shifted my thinking on this, and it's something most people aren't paying attention to. For years, the assumption was that China needs the dollar system as much as we do. They export to us. They hold our bonds. If the dollar collapses, they lose value on their treasury holdings and their export market shrinks. Mutual assured destruction. So they won't rock the boat, but that logic doesn't hold anymore. China's export dependence on the US has been declining for years. In 2000, about 20% of Chinese exports went to America. By 2024, it's under 15%. Meanwhile, their exports to the rest of Asia, to Africa, to Latin America have been growing. They're building an entire Belt and Road network of countries that trade with China and yuan. And those treasury holdings, they've been selling them down slowly for over a decade. They're diversifying into gold, into commodities, into real assets. The pain of a dollar decline is less than it used to be. More importantly, look at what they're building. The CIPS payment system I mentioned earlier. It's handling over 80 trillion yuan in transactions as of 2024. That's real infrastructure. It works. They've signed currency swap agreements with over 40 central banks. Total value of those swaps is over 4 trillion yuan. Those aren't symbolic. They're actual lines of credit that let countries trade without dollars. The digital yuan, their central bank digital currency, is being tested in cross-border transactions with Hong Kong, Singapore, Thailand, UAE. That's a payment system that settles instantly, no correspondent banks needed, no SWIFT needed, no dollars needed. This isn't preparation, this is deployment. And here's the thing that really changed how I see this. In October 2024, at a BRICS finance ministers meeting, they discussed creating a new payment system specifically designed for BRICS trade, not based on any single currency, but a unit of account backed by a basket of commodities and currencies. The details are still vague, it might not happen. But the fact that finance ministers from countries representing 35% of global GDP are having that conversation tells you the direction. They're not trying to destroy the dollar, they're making it optional. And optional is enough. Because once there's a real alternative, once countries can say, we don't need dollars for this transaction, the leverage shifts. Suddenly, the US can't use the financial system as a weapon without pushback. Can't freeze reserves without countries moving assets somewhere else. Can't run unlimited deficits without consequences. It's not about fairness or justice or multipolarity. It's about math. The US is 4% of the world's population running 25% of global GDP with 36 trillion in debt. That only works because we control the reserve currency. Take that away, and the math stops working, and the math is starting to break. Let me show you what this looks like in real time, because it's already happening in ways you can measure. Go look at gold prices. In 2020, gold was around $1,800 an ounce. By late 2024, it's pushing past $2,600. That's a 44% increase in 4 years. Why? Because central banks are buying. Not Western central banks, BRICS central banks. China's central bank bought over 300 tons of gold in 2023 and 2024. That's the most aggressive buying they've done in decades. Russia's been accumulating gold since 2014, right after Crimea. India bought 19 tons in the first half of 2024 alone. Turkey, Poland, Czech Republic, all buying. According to the World Gold Council, central banks bought over 1,000 tons of gold in 2023. That's the second highest annual purchase on record. And the buying is concentrated among countries that are either in BRICS or aligned with them. They're not buying gold because they think it's going to $10,000 an ounce. They're buying it because it's the one reserve asset that can't be frozen, can't be sanctioned, can't be weaponized. You hold physical gold in your own vaults, and nobody can take it from you with a phone call to a New York bank. That shift from dollars and treasuries into gold is a vote of no confidence. Not loud, not dramatic. Just steady selling of dollar assets and steady buying of hard assets. And it's not just governments. Look at what sovereign wealth funds are doing. The Saudi Public Investment Fund, which manages over $900 billion, has been diversifying heavily into Chinese stocks, Asian infrastructure, European real estate. They're still holding US assets, but the percentage is dropping. Same with UAE's sovereign funds. Same with Qatar. These are the countries that used to recycle all their oil revenue into US treasuries. Now they're spreading it around. You know what that means? When the US Treasury runs a deficit and needs to sell bonds, there are fewer automatic buyers. The auction's still clear, but the yields have to be higher to attract enough interest. And higher yields mean higher borrowing costs for everyone. Now, let me connect this to something you're probably feeling, but maybe haven't connected the dots on. Your grocery bill. It's up. Way up. Not just because of inflation, because of where inflation is coming from. The official CPI says inflation peaked around 9% in 2022 and has come down to maybe 3 to 4% now. But your actual cost of living doesn't feel like 3%. It feels like 10% or 15% year over year. Part of that gap is how CPI is calculated. They adjust for quality, they substitute cheaper goods, they smooth the numbers, but part of it is currency. When the dollar weakens against other currencies, imports get more expensive. A huge chunk of what Americans consume is either imported or made with imported components. Electronics, obviously, clothes, furniture, but also food. The US imports about 15% of its food supply directly, but even domestically grown food uses imported fertilizer, imported machinery parts, imported packaging. When those inputs cost more because the dollar is weaker, food prices go up, and energy. The US is technically energy independent now. We produce enough oil and gas to cover domestic needs, but oil is a global market. If oil is trading at $85 a barrel and the dollar weakens by 10%, the dollar price of oil has to rise just to maintain the same real value to producers. So your gas goes from $3.50 to $3.85, not because oil got scarcer, but because the dollar got weaker. This is the hidden tax of losing reserve currency status. It shows up as inflation, but it's really currency devaluation. And there's no policy fix that doesn't involve pain. Raise interest rates to defend the dollar. You crash the economy. Keep rates low to support growth. The dollar keeps weakening and inflation stays elevated. There's no good option once you're in that trap. Now here's the part that affects your future, not just your present. Your retirement account, your 401k. It's probably heavily weighted toward US stocks and bonds. That's normal. That's what everyone does. Home country bias plus the assumption that US assets are the safest. But if the dollar loses reserve status, US assets become riskier. Not worthless, not collapsing, just riskier. Treasury bonds stop being the global safe haven. They're just another country's debt, a country with a 123% debt to GDP ratio and $1 trillion annual deficit. US stocks become more volatile because companies that depend on imports face margin pressure, and companies that export face tougher competition as other currencies strengthen relative to the dollar. The whole portfolio that was built on the assumption of American economic exceptionalism has to reprice. And here's the really uncomfortable part. If you try to diversify now, if you say, okay, I should have some international exposure, some gold, some assets outside the dollar system, you're late. Not too late, but late. The central banks already did this. The sovereign wealth funds already did this. The billionaires, they've been diversifying for years. Bill Gates buying farmland, Bezos buying ranches. These guys aren't dumb. Now regular people are figuring it out, but the easy gains from diversification are gone. Gold at $2,600 is a lot more expensive than gold at $1,200 where it was in 2015. So what do? I can't give you financial advice. That's not what this is, but I can tell you what the pattern suggests. Historically, when reserve currencies lose status, hard assets outperform financial assets. Real estate, commodities, productive businesses, things that generate value regardless of which currency is dominant. Cash becomes dangerous. Bonds become dangerous. Anything that's a promise to pay you dollars in the future becomes risky because you don't know what those future dollars will be worth, and skills become valuable. This sounds soft, but it's real. When currency systems are unstable, people who can provide real value, real services, tangible skills, they do okay. It's the people whose wealth is purely financial, purely paper, who get wiped out. Look at what happened in Britain when the pound lost reserve status. The people who owned land, who owned businesses, who had skills, they adapted. Their wealth declined in absolute terms, but they survived. The people who were entirely in pounds and bonds and pensions denominated in a weakening currency, they got destroyed. I'm not saying the dollar is going to zero. I'm not predicting collapse. What I'm saying is that the mechanics that have supported the dollar's dominance for 50 years are breaking down in real time. And when that support goes away, everything built on top of it has to adjust. Your savings, your mortgage, your job security, your retirement, all of it is downstream of this. So let me bring this back to where we started. August 2023, BRICS expands. 6 new members. Sounds like just another international summit, another alliance that doesn't mean much. But then the oil sales in yuan started, the currency swaps expanded, the alternative payment systems went live, the central banks started buying gold and selling treasuries. None of it was dramatic. None of it made CNN. But all of it was real. And now you understand what you're actually watching. This isn't about ideology. It's not about America versus China or democracy versus autocracy. That's the framing you'll hear, but it misses the point. This is about countries looking at what happened to Russia in 2022 and realizing that holding your reserves in a system controlled by someone else is a vulnerability. And when you have an alternative, even an imperfect one, you start using it. Not to hurt America, just to protect yourself. But the effect is the same. Every trade that settles in yuan instead of dollars is demand that disappears. Every treasury bond that gets sold is support that's gone. Every alternative payment system that gets built is leverage that shifts. The dollar isn't going to collapse next month. This is a slow process. It took 30 years for the British pound to fully lose its dominance after Bretton Woods. This will probably take a decade or more to fully play out. But the direction is set, and understanding the direction lets you see things differently. When you hear about inflation, you can ask, how much of this is currency weakness versus actual scarcity? When you hear about interest rates, you can ask, how much of this is the Fed fighting inflation versus defending the dollar's global position? When you see gold hitting new highs, you don't have to wonder why. Central banks are voting with their wallets. When BRICS makes announcements about new payment systems or commodity-backed currencies, you won't dismiss it as posturing. You'll recognize it as infrastructure being built for a world where the dollar is optional. And when you think about your own financial decisions, about where to hold savings, how to structure investments, what risks to worry about, you have a framework now. The system that's been stable for your entire life, the one where dollars are automatically valuable and US assets are automatically safe, that system is built on relationships and agreements that are quietly being rewritten. Not overturned, not destroyed, just made optional. And optional is enough to change everything.